This is Satya Pradyuman of Cirrus Research. The latest issue of the briefing, it's titled Rate Vol Threatens the Nifty-7. At the heart of this is the case that we've seen 7 stocks truly dominate the equity markets year to date in terms of performance. What's interesting is we've seen more volatility in those stocks in the last 6-7 months. And to some degree, quite a bit of that we believe has been driven by interest rate volatilities. The idea is that when we look at the levels of valuations in the largest tech firms in the US, we're looking at record tech valuations. This is not a surprise. What is shocking, though, is that the valuations relative to the rest of the tech space in the US is radically departed from norms. And so we're looking at 20, 30-year valuation gaps between largest techs and rest of tech. This is important because what we're also recognizing is that technology spending is slowing, industrial spending continues to accelerate. So this sort of gap that exists links back to the behavior of these stocks with interest rates. The idea that if the fundamentals aren't really in place, interest rates really matter. And so what we're at right now is this chart represents basically the year-to-date performance of the way the extended FANG stocks have performed. This is the purple line against the interest rate vol, the MOVE index. And what it shows is that in the recent month, we've seen net negative numbers in terms of performance. But what really occurred, it was a tale of two cities, that interest rates had backed up in the first part of the month sharply and then started to rally back in. The volatility numbers actually support that. So the point here is that the fundamentals are fairly stretched. However, we almost need a recession to get the Fed to come to the rescue for these shares. And so we think that's going to be less likely as we get through 23. And it's to be debated in 24 if the Fed needs to come to the rescue. So I think this is a really important point as some clients are looking to diversify, maybe not bet against tech, but look for smarter ways to really stem some of the risk, the inherent risks that are there. Another point to bear in mind is as much as there's been a lot of talk this year about AI and the dominance of AI and high-end chips, when we look at performance besides the Nifty-7, what you'll see is that industry groups like home builders, building materials, hotels, casinos, these are groups that are up over 40% year to date. And so to some degree, this market has begun to broaden. So why is this important and very timely? The idea is that the consensus is beginning to agree with a soft landing hypothesis. If that's the case, then more stocks are going to generate profits that markets are going to like. If this market is so stretched with the narrowest few, the valuation gaps allows for investors to chase firms that surprise on the upside. So we think this is interesting. I think this is the buildup for the back half of the year and going into 24. Keep an eye on this space. And then finally, a look at the active manager results. We use as proxies the Cirrus active blends. And one thing that's been super clear, and we're still trying to figure this out, but I thought it's really worth flagging. There is a massive dichotomy in terms of the relative performance between the largest portfolios, large cap growth portfolios versus small cap growth portfolios. The smaller cap models just work better. So the question here is what is going on? And a lot of that is really this idea about the largest few names driving the benchmark, which makes many active managers really suffer. Another way to think about this, though, is that if fundamentals don't matter, then most active portfolios are going to lag. Fundamental variables really drive our portfolios. And as a result, in large cap land, I think this basically suggests that fundamentals really haven't mattered. And so the active large cap manager probably needs to breathe a little bit and realize this is endemic. It is not their performance per se. This is repeated in the value portfolios that we're running. We're also looking at lackluster results for large cap value results, whereas the small cap models seem to be working a lot better. So we think for active managers, this is super important to recognize that performance is driven by a broader participation if you're going to run a diversified portfolio. That is not what's happening in the market, at least year to date. With any questions, feel free to reach out. Thank you.